Hello, thank you so much for joining me on Morning Markets. I'm Amber Kanwar. We are watching the bank stocks, three more reporting a mixed set of quarterly results. Some winners, some that are struggling this quarter. We had Royal Bank, CIBC beat profit expectations, boost their dividend. And then you have TD not only missing expectations, but also announcing a pretty massive restructuring as it looks to lower its headcount. There's some common themes, however. All of these banks boosting their dividend, all of these banks continuing to struggle with expense growth, growing between 12 and 13% for Royal and CIBC, 20% for TD Bank. There's a lot to go through here. I'm not going to do it alone. We've got Paul Bagnall, who has gone through the numbers. Christine Dobby is listening to the conference calls we've had so far, and a shareholder in these banks in Paul Harris, part of Harris Douglas Asset Management. Paul, I'd like to start with you, kind of the high-level takeaways that we have seen from these banks this morning.
Well, let's start with TD Bank. It's clearly the outlier here. As you can see in early trading, investors are selling the stock down. This is the bank that missed earnings expectations, but there's more to it than that in terms of negative news for TD Bank. It had a weak quarter in the United States. As we take a look at the earnings miss, it also, while it certainly did not issue a profit warning, it did say that it will be challenged to meet the financial targets, financial growth targets, and return on equity targets that it has earlier set for itself. So here are some of the takeaways, Amber. It was an earnings miss. Provisions for credit losses rose from the third quarter to the fourth quarter. Again, it says it will be challenging to meet its 2024 targets on earnings per share growth and return on equity. Profit was down in Canada and down in a big way in the United States. Profit in the United States on an adjusted basis declines by 19% at TD Bank. The bank blames higher non-interest expenses, so higher expenses, as you noted, higher provisions for credit losses, and lower revenue. Not a great combination of negative factors in the U.S. The bank, after all of that, did raise its dividend. Here's a quick look at RBC. RBC has topped earnings per share with earnings per share of $2.78. Like TD, it did dial up its provisions for credit losses from the third quarter to the fourth quarter. Like TD and CIBC, it did raise its dividend, but profit growth very difficult for these banks to come to achieve in their core personal and commercial retail banking franchises. It sagged by 2% at Royal Bank of Canada. As you noted, the strength was in the capital markets segment, which often gets viewed as a less high quality source of earnings growth. And finally, CIBC also beats earnings expectations with $1.57 in earnings per share. Of the four big banks that have reported thus far, this is the only one that dialed back somewhat, not by a huge amount, but dialed back its provisions for credit losses from the third quarter to the fourth quarter. And the profit, again, no profit growth in personal and commercial banking for CIBC. It was essentially flat. It declined very, very modestly, and there was a dividend increase. So some good news for investors of all three banks today. All
right, that was a fabulous summation. Paul Bagnall, best in the business. We appreciate it. Christine, you were listening to the conference call. Paul was highlighting this interesting nuance with CIBC. On one hand, their provisions for credit losses were a little bit lower than expected. On the other hand, their impairments, specifically with the commercial real estate, are starting to move higher. Were analysts trying to get at that in the conference call?
Yeah, unfortunately, I wasn't listening to that conference call. I did tune into the RBC conference call. I'm really grateful to Paul for summarizing everything that's been going on in what's a very, very busy morning. I know that CIBC has been trying to, I would say, downplay the U.S. commercial real estate risk. They're really emphasizing that it's a very small part of their loan book. And they wanted to emphasize as well this quarter that they have done well on expense management, and they're one of the only Canadian banks to have positive operating leverage. So that's definitely been a theme that they're emphasizing.
Well, let's talk RBC, because I caught part of that call, and I noted there were kind of three areas investors want to know about: City National, when is it going to return to growth? Why is capital markets doing so well? And of course, the HSBC transaction.
Yeah. Yes, and we did hear a lot from CEO Dave Mackay on City National and on the HSBC transaction. On that one, he said he does remain overall very confident about that deal getting approved. As you know, it's been facing some pushback, some political pressure. Pierre Poilievre has come out against it in recent weeks. Dave Mackay said that it would send a very bad signal to foreign investors if this deal was not approved, and he emphasized that it has many benefits for Canada. On City National Bank, this is a U.S. regional bank based in California that has had some issues with its balance sheet. It's faced many of the same pressures that many U.S. regional banks have faced, with deposit outflows, higher cost of funding. Dave Mackay did say that they have cut 5% of staff at City National, and that they're really hoping to turn a corner and return to profitability next year, and really have the year that they were hoping to have this year with that bank.
You know, I noted the overall tone for Royal was maybe cautiously optimistic. I mean, they talked about record revenue in some parts of their business, which is astounding considering the year that we've had, and optimism that HSBC does get done. And I want to contrast that with TD, which is saying we might have difficulty hitting our growth targets. Their conference call is not until 1:30, but I imagine there's going to be a lot of questions around that.
Yeah, I think there's a lot of questions that TD is going to be facing today. One issue that we haven't touched on yet is the anti-money laundering investigation that it faces with the U.S. Department of Justice. And they haven't provided much more information on that yet. They did say in their disclosures that they believe it will be a manageable penalty if they face anything. But I think they will face more questions about that. Analysts have said that they could face, between $500 million and $1 billion U.S. Penalties on that. So there's some uncertainty there. There's also uncertainty around, they've now said that they're taking these large restructuring charges. They've also, as Paul said, not a profit warning, but they have said that they expect that the macroeconomic climate will pose challenges for them in the next few quarters.
All right, thanks so much for that roundup, Christine. And again, TD's conference call is at 1:30 p.m. Eastern Time, so there'll be more breaking headlines from that. Now I want to bring in Paul Harris, who's been patiently listening to this analysis of Harris Douglas Asset Management. You own the Canadian banks. As a shareholder, this quarter kind of marks the year end of what's been kind of disappointing performance from these bank stocks. But as a shareholder, what did you see? What are you holding on to that makes you think this is still a sector worth being in your portfolio?
Well, so from a valuation perspective, I don't think they're very expensive, right? I mean, they are either trading at sort of kind of 1 times book to 1.5 times book. They've got dividend yields well above 4%. Most of them, I think Royal's closer to 4%, but they're in the high mid to 4% range, and some of them are in 5 or 6% range. So you're not, from that perspective, their valuations are not extreme expensive or anything like that. So that's one thing. But so if you're going to look at buying the banks, this is the time to kind of buy them when valuations are at these levels. But I would say from a quarterly basis, I mean, there's a lot of things that there's sort of a lot of information in the quarter, and it was very mixed and very messy. But I would say that the issues are some of the issues are, I think I'm looking at is one is the loan loss revisions, loan loss reserves, which everybody knew they were going to go up, and most of them raised them except for CIBC. The issue that I found interesting is with many of them is that they actually put aside money for loans that are actually paying them. So that's kind of why are they doing that? I mean, are they feeling uncomfortable with the Canadian economy, especially if somebody's paying on their loans? It's an odd thing to do. So that's one thing. The other thing is that it's clear that most of these guys have a very bad expense ratio business, right? So they've really got to cut expenses over the next little while. And they're doing that, but it takes a long time for a bank to change its it's the expense side of it, because so much of it is to employees and stuff that banks don't, in this country specifically, wouldn't lay off 10 or 15% of their staff. If they had to do that, they would do it very slowly over a period of time. So I think that's the area that they've got to really work on, and I think that they will. And so I think those are the two things that are really important. I think the other thing is that there's been very little growth on the retail side, which is, Canadian banks are great at retail, and especially CIBC and the TD, and they've suffered a lack of growth there. And so that used to be kind of a nice buffer for the other parts of the business, which were capital markets, et cetera. So, I think that you want to buy these things here at these levels because you're not paying a lot for them. But I think that it maybe take time for them to, I think everybody's expecting, because I think Paul mentioned this already, the last 2 years have been negative for banks, and that's rare. That is rare. But, it doesn't mean you're not going to have next couple of quarters are going to be more difficult, and then you may see some upside on these things. But I don't think you're buying them at extreme multiples or anything like that. And I think you can make money on these things, and at the very least, you're getting a very high dividend, and they will continue to increase their dividend. And the other thing is that you have to remember that Canadian banks are actually well capitalized. All these banks have great capital. Even with the increase in capital requirements, they're still all well capitalized. So that's not an issue for Canadian banks that it was maybe for some other banks globally, but Canadian banks are in great shape, and that's really important, but it goes to our regulation in this country, right? They are really highly regulated and well regulated, unlike sort of the United States, et cetera. So to me, you've got great regulation, they've got great capital, you're not paying a lot on price to book, you're not paying a lot on earnings as well, and you're not paying a lot and you're getting a really great dividend. So I would say you want to buy these at these levels, right? And and I've been on the show before, Amber, you said, I said buy them before as well. But I think that the argument for me is that they probably kitchen sinked a lot of this stuff and in this quarter. And I think that going forward, like even with TD, they've already told you that they're going to take a big write-off in the second half, of next year. So even if they come in less than that, people will push up the stock, right? So
I am grateful for this sort of clear-eyed analysis. The takeaway here, you want to buy the stocks on valuation, that the number you're focusing on is credit quality, and that does not spook you off. And on expenses, you're confident that they can bring you down. And so I want to use that lens and kind of take it on a bank-by-bank basis. You mentioned TD. The main thesis, everybody says, I like TD for the U.S. exposure, but the U.S. exposure has been a problem. You're seeing declines there, even in their recent acquisition of Cowen. That's not really performing. Are you prepared to weather that out, believing that, the ultimate thesis on buying TD for U.S. growth is still intact?
So we've owned TD for a long time. So I think the U.S. business is perhaps probably from a perspective of all the other banks is a good business. They certainly have a brand in the U.S. which I don't think other banks, maybe BMO is the other one, but that any other Canadian bank has. What I liked about TD for many years is that they've got a great Canadian franchise, right? And that, they were able to make these purchases in the US and grow their franchise there with the hope that they get a reasonable amount of scale that allows them to be profitable there, right? So that's the idea behind what I felt about TD in that area. I think TD has a great business in this country. It has great capital markets in this country. They're not like the Royal. The Cowen deal, I think that takes, when you buy an investment bank, it's a much harder transition than buying other businesses, right? So it's all about people and, people, because it was a private company, people leave. So I think it's a much harder transition, and it takes a lot longer than people think to get a cohesive group to work together and be effective. The problem with investment banking, and the Royal is a perfect example of that, you really have to be in the top 10 to really make a lot of money, top 5 to make a lot of money, top 10 at least to make some money in investment banking. And I'm not sure that Cowen gives TD that edge or not, right? So I think that's the problem with that. If you're going to buy an investment bank, you want to buy something that gives you big scale, right? And I don't think that does that, but that may be help. Maybe that's what they want. They want that mid-market range stuff that they were looking for.
And certainly Royal was sort of the other side of that, showing strength, record numbers in capital markets. There was a lot of questions about HSBC, whether it will get done, whether there will be additional concessions or commitments that will be required to get regulatory approval, which the CEO kind of sidestepped that question, said I'm not able to speak to that, but did say, very emphatically that it would be bad if this deal was not approved for the country. As a shareholder, is it a nice to have, not a need to have?
I mean, I think the Royal, I'm not sure that they needed to buy it by any means, because they have a very strong business in this country on the retail side and commercial side. Maybe they wanted it for some of its advantages that they give them maybe internationally. But I think that, bank deals are always politicized in this country, right? And so there's nothing you can do about it. So it's always going to be like that because there's not that many banks, and it's always seen as, oh, it's going to cut competition. But I don't think it makes that much of a difference on competition. That's one thing. I mean, we constantly do this on the telecom side as well, right? So, we're a small country, so I don't see if they don't buy it, I'm not sure what our HSBC does, right? They probably leave this country. They don't have a mandate to be here anymore. And so that's why they're trying to sell the business. So I'm not sure who else would look to buy it. Sorry, go ahead.
Well, I only have like 20 seconds left, and I want to ask you about Scotia because you are such a broad-based buyer of the banks. That was the one that was under the most pressure so far in earnings season. There's a lot of question marks around this. What's the strategy? What's the new CEO going to do? Where's your conviction on buying this stock?
Right. So on Scotia, I think the issue is that it's really a big restructuring story, right? So somebody came in that's not a banker, that's really restructuring the business. They are reevaluating their international exposure, looking for places to exit areas that they don't actually get a return on capital on. So I think it's a much longer term story for something like that. I do think that Scotia gets a high multiple at times because they have international exposure, but now they don't, right? So I think that the issue for them is to really rationalize their business. I think he's doing that. I think Scotia, the other problem with Scotia over the years is they were never one of these people that spent a lot of money on technology. They were late to the asset management business in some ways. So I think Jackie Allard has taken over that side of the business, and she came from RBC. So I think that he's putting in people in place that are actually going to grow the business over a period of time. But I think it takes a lot longer. I mean, I think you had a guest on a couple of days ago that talked about Scotia and said, these are tankers. It's hard to move them around, even on the cost side. You're never going to get a bank, laying off 10% or 15% of their staff. It's too political, and so they do it very slowly. So that's what takes the time, right?